Have you ever just stared at a wall of financial data for a stock and your eyes just kind of glaze over? You see all the numbers, all the ratios, and you just feel completely lost? Right? You see all this stuff for a company, say Citizens Financial Group, and you're thinking, okay, now what? What does any of this actually mean? Is this company a good deal? Is it even a healthy business? Honestly, it can be pretty overwhelming. But what if we had a way to cut through all that noise? What if we had a simple guide, a checklist, to help us make sense of it all? And not just any checklist, but a framework inspired by one of the greatest investors of all time, Warren Buffett. Well, that's exactly what we're going to do today.
So here's our game plan. First, we're going to lay out our simplified version of the Buffett checklist. Then, we'll put Citizens Financial Group through the ringer, asking, is the price right? Is the business making money? And what about its growth? Then we'll hit the big one, the margin of safety, before we wrap it all up on our final scorecard. Let's dive in.
Okay, before we begin our investigation, just a really quick but important heads up. This is not investment advice. What we're doing here is learning a method, a way to think critically about a company's health. It's all about learning how to analyze, not being told what to think.
So our checklist boils down to 4 pretty straightforward steps. First, we got to figure out if the price makes sense. Second, we need to see if the business is actually profitable. Third, we're looking for consistent performance over time. And last but definitely not least, we have to ask if there's a margin of safety to protect us. All right, let's get into it, starting with step 1, the price.
First stop on our journey is valuation. We're basically playing detective here, looking for clues that tell us whether Citizens Financial Group, we'll call it CFG, is a good value at its current price. And right away, we find a really big clue. It's called the PEG ratio. Now, all you really need to know is that this number compares a stock's price to how fast its earnings are growing. Value investors love to see a PEG ratio under 1.0. Well, CFG's is 0.43. That's not just a green flag, that's a giant green banner waving at us.
But hold on, not so fast. This is where the story gets a little complicated. Because while that PEG ratio looks amazing, another metric, the price to earnings, or PE ratio, tells a totally different tale. Think of the PE as the stock's price tag. And right now, that price tag is almost 15% higher than its 3-year average, and a full 20% higher than its 5-year average. So what gives? It looks cheap based on its growth, but kind of pricey based on its own history. That's a puzzle.
Before we try and solve that, let's just do one quick sanity check. We're going to look at debt. The debt-to-equity ratio here is 0.37. That's a nice low number. It tells us the company isn't drowning in debt, which is always a good sign. So for financial stability, that's a definite check in the plus column.
Okay, next up, profitability. Because, getting a good price is one thing, but it doesn't mean much if the business you're buying isn't very good at making money. So let's check under the hood and look at CFG's engine.
And our main tool for this is return on equity, or ROE. The easiest way to think about this is like a report card for the company's management. It shows us how good they are at taking shareholders' money and turning it into more money. You want to see a high and steady grade. So here's CFG's report card. Right now, its ROE is 7%. Now that's actually an improvement over its 3-year average, which is great. But you can also see it's still just a little bit below its 5-year average. So the trend is positive for sure, but it's not quite back to its peak performance from the last few years.
All right, now let's talk about growth. And here's the thing, it's not just about raw growth numbers. The quality of that growth is just as important. Are we looking at a nice, steady climb or a wild, unpredictable roller coaster? And at first glance, wow, the performance looks absolutely spectacular. A total return of more than 54% in just 1 year. I mean, that's a monster number. If that's the only thing you saw, you'd be incredibly impressed.
But I think you know what's coming. When we zoom out and look at the year-by-year returns, a completely different story emerges. This thing is a roller coaster. You get these massive, fantastic up years, but they're followed by these really painful down years with double-digit losses. This is anything but a smooth and predictable ride.
So what does this all mean? It tells us that the short-term performance has been phenomenal. No doubt about it. But the long-term track record is one of high volatility and inconsistency. And for an investor like Warren Buffett, who absolutely loves predictable, consistent businesses, well, this kind of pattern would raise some serious questions. Which brings us to our final test. And honestly, this might be the most important part of the entire Buffett philosophy. This is the big one. We're talking about the margin of safety. And the idea is actually really simple, but it's so powerful. It just means you figure out what a company is truly worth, its intrinsic value, and then you insist on buying it for a lot less than that number. That gap,
That discount between the value and the price you pay, that's your protection. It's your safety net against being wrong or just plain bad luck. So here we are, the big question, the climax of our whole investigation. After looking at its price, its profitability, and its growth, does Citizens Financial Group pass this final, crucial test? And this is where things get really, really weird. Because we have two different ways of calculating the company's value, and they give us two completely opposite answers. If you look at it based on its official accounting profit, or EPS, the stock looks overvalued by almost 26%. But if you look at it based on free cash flow, the actual cash the business generates, it looks undervalued by over 22%. Now, this happens because accounting rules can sometimes make profits look different than the real cash that's coming in the door.
Okay, we have examined all the evidence from every angle. It's time to put it all together and see where we stand. Let's head to our final scorecard for Citizens Financial Group.
And as you can see, it's a perfect study in contrasts. For every pro, there's a con. We've got a great PEG ratio and low debt, but the PE ratio is historically high. Profitability is improving, but it's not back to its peak. The one-year growth is amazing, but the long-term record is super volatile. And that margin of safety, it's the ultimate split decision.
And you know what? That's really the most important takeaway here. The point of using a framework like this isn't to get a simple buy or sell at the end. It's about building a process for critical thinking. It forces you to look at the whole picture, to weigh the good against the bad, and to understand the nuances of a business.
So I'll leave you with the one question every investor ultimately has to answer for themselves. When the numbers tell two completely different stories, when one says it's a bargain and the other says it's overpriced, which one do you believe? Answering that is the real art of investing.